So on the surface, the Canadian economy showed surprising strength in the third quarter, with GDP up at a 2.6% annualized rate. But let's get more on this from Michael Davenport, senior economist at Oxford Economics. Thank you very much for joining us. Seeing quite a bit of commentary today that this number looks good, but it's masking underlying weakness in our economy.
Good morning. Thanks for having me. Yeah, so the headline GDP print was certainly stronger than expected. It was stronger than our expectations. It was stronger than the consensus of economists and the consensus in the market, and also stronger than the Bank of Canada's forecast. The Bank of Canada's estimate for the third quarter. However, what we saw was actually that headline strong GDP print of 0.6% quarter on quarter was flattered and boosted by a large decline in imports. So imports fell 2.2% quarter on quarter. That was the largest contraction in imports of goods and services since the fourth quarter of 2022. And so actually, if we look at the spending of households, businesses, and governments in the economy, so what we call final domestic demand, that was actually flat quarter on quarter in the third quarter. So a much weaker picture for the Canadian economy once you look past the big decline in imports and sort of focus on the spending of businesses, households, and governments domestically.
And government spent heavily. A lot of that tied to the defence build out, but there certainly wasn't strength in business investment, that perennial problem.
Absolutely not. So business investment fell, whether it be non-residential structures, so non-residential construction, machinery and equipment also declined, and investment in intellectual property products fell. So all of the three major categories of private sector business investment declined. That follows declines for machinery and equipment investment in particular in the second quarter. And we think that continues to reflect not only significant U.S. tariffs that are causing firms to pull back on their major capital expenditure plans, but also this environment of uncertainty created by trade policy uncertainty. Businesses not having certainty about access to the U.S. market, we think that's a key factor that's continuing to cause them to pull back on their investment, to put off major new capital expenditure plans. And we think that's something that's likely going to continue until a trade deal with the U.S. Is finalized.
And can you just remind me, when you get imports down, does that boost your GDP number?
Exactly, yes. So imports are subtracted from GDP. You can think about it as when a Canadian buys, whether it be a household or a firm or government, buys goods or services from outside of the economy, that is an import. And so that money is leaving the economy, and that gets subtracted from the aggregate amount of goods and services produced, or in the case of GDP on an expenditure basis that we're talking about today, the total amount of goods and services purchased, or the total amount of spending in the economy.
I mean, GDP, well, it's hard. I mean, you got an economy of 40 million people. It's hard to measure. It's a complex entity you're trying to track. But GDP is a flawed measure in many ways.
Well, some people would say so. It definitely does not capture all aspects of, say, economic activity, all aspects of the economy. We look at a wide range of indicators when we try to gauge what's actually going on the ground in the economy and what's likely to happen going forward. If you look at other indicators, for example, indicators of the labor market, paints a much weaker picture, I would say, in the third quarter in particular. Now, the labor force survey, we've seen some pretty strong job growth numbers, headline job growth numbers in October and September. However, the survey of payrolls, which is a less timely but often more reliable measure of total employment in the Canadian economy, has been much weaker, shown job losses for several months, and another large decline in September. That data was just released earlier this week. So yes, GDP is not an all-encompassing, measure or a final overall statement on how well the economy is doing. In this case, again, that strong headline GDP figure was boosted by imports. It doesn't necessarily mean that the Canadian economy is booming, and we don't expect growth to continue at this pace going forward.
I know productivity gets discussed ad nauseum, but is there any actual potential for the value added by Canadian workers to increase significantly in years to come? Because governments have just failed to achieve on that metric.
We're somewhat optimistic on the productivity outlook, looking out, let's say, the next 5 to 10 years. Canadian productivity has been incredibly weak over the last 5 to 10 years, as you point out. However, we do expect there will be somewhat of a recovery in the next over the next little while. That in part reflects technological developments, so things such as the positive impacts of artificial intelligence, which should over time lead to productivity improvements. And also, we're starting to see the pendulum swing a little bit on the government side towards more of a growth forward agenda, whether that be through support for major natural resource projects. We just saw the big announcement yesterday, the memorandum of understanding between the Calgary provincial government, the Alberta provincial governments and the federal government, that they do want to get a pipeline built. We've seen other announcements of major nation-building projects focused in the natural resource sector in particular. Those over time, if realized, should help to improve aggregate productivity in the Canadian economy. And we do think that will occur over time. We've also seen the government start to bring forward more measures targeted at improving productivity and getting more business investment, sort of remedying the long-standing lackluster business investment issue that has really plagued the Canadian economy for several years.
Well, we see the support for resource projects, but the population, as you know, is in central Canada, and we don't seem to see the same emphasis on high-tech manufacturing, for example.
Yeah, absolutely. I mean, I think what we're seeing with the resource projects, these are in many respects the somewhat low-hanging fruit. The projects that the government has identified as areas that they can quickly get money moving, get shovels in the ground, and get more Canadian products to market. And that should help to improve productivity as well as broader economic growth. Now, you're absolutely right. We can't just see growth in the natural resource sector. What we need to see is more productive high-tech manufacturing investment as well. And we're hopeful that will come over time.
Thank you very much, Michael. Really appreciate it.
My pleasure. Thank you for having me.
Michael Davenport, senior economist at Oxford Economics.